Thank you very much for the introduction once again, Neil. This is the quarterly update on the Nedgroup Investments Global Emerging Market Equity Fund for Q3 24. It was a strong quarter for the asset class, with MSCI Emerging Market up 8.7% to give a 26.1% return year to date, over 1 year. The portfolio disappointingly lagged the broader market, only gaining 1.6%, so quite a significant underperformance in Q3. That gives a 1 year number of almost 22% for the fund. So we need to dig a little bit into what didn't work for the portfolio during the past quarter. So if we look at the past quarter, as I say, almost 7% behind the benchmark, very disappointing period. There were 4 main contributors to relative performance. We had a difficult time in China, a difficult time in India, and a difficult time in also Korea and Taiwan. So Korea and Taiwan, those two markets sold off the first part of the quarter. They sold off mainly as AI-linked technology names in the US came under pressure. So a lot of our tech positions in those two markets came under pressure, while India sold off as a result of some domestic regulatory issues. So the regulators in India were concerned that markets were getting too frothy, and they decided to force deleveraging on some retail investors, which hit mid-cap names and unfortunately had an impact on the portfolio's performance. And then finally, in September, we had some significant policy changes in China, which led to an almost 35% rally in that market. The market calmed down shortly after that 35% rally, and it finished the period up 24%. However, our portfolio in quality and in growth names in China lagged that broader market rally, gaining only 17% for the period. So if you look at it on a sector basis, the things that negatively impacted the portfolio over the quarter were our stock selection in IT, in consumer staples, in discretionary industrials and healthcare. Some things did work in our favor, but they were obviously more than overwhelmed by the things that went wrong. So we had positive stock selection in Hong Kong, in Malaysia, and in Brazil. Our underweight in the Gulf region continued to deliver positive returns on a relative basis. Our overweight in consumer discretionary was positive, but unfortunately not our stocks. And our underweight in both energy and materials were positive for performance. In terms of individual names, you can see here that Kia Corporation in Korea was a big detractor from relative performance. So the global economic slowdown that we're starting to see come through was a negative for volumes in terms of car sales for the Kia Corporation group. And so that sold off as a result of that. And then in India, some of our mid-cap names, which have been very big contributors to relative performance in the past, went through a difficult period. So these are still strong performance contributions year to date, but during the Q3, they were detractors. So Max Healthcare Institute, which is a private sector hospital delivering strong growth and expanding, underperformed the broader market, as did Varun Beverages, the Pepsi-Cola bottler, which, although it delivered strong revenue and EBITDA growth, and that's been almost 30% in terms of EBITDA over the past decade, this quarter it was a mid-cap, and those names came under pressure. Things that did work for us: AIA Group in Hong Kong, that stock bounced as Chinese policy pivoted towards reflation. The company has been posting consistently strong results, so we added to our position there during the rebound in China. In Malaysia, Public Bank Berhad, which is a quality bank in a liquidity-sensitive market, Malaysia, that benefited from falling rates, and it's a US dollar weakness beneficiary. So it's a China plus one winner, and it's been seeing improving mortgage demand in the market. And then another Chinese name, East Rock Beverage, a Chinese energy drink maker, that's geared into the consumer recovery, and that was strong on hopes of further stimulus news. What did we do to the portfolio? So, there were a lot of things going on. We had been reducing Korea and Taiwan weightings as we went into the quarter. We continued to do so. We added to some of the interest rate sensitive markets in Southeast Asia. So we added to Indonesia and the Philippines. There was a modest increase in our Indian positions as some of our favorite names sold off, and also a slight increase in our Brazilian exposure, which remains underweight. We rotated to our favorite positions in China and used some of our more defensive names in that market to add to those. And overall, if you looked at the sector level, we had added to financials while continuing to reduce our IT overweight. So in terms of the outlook, how are we positioned now as we look forward? Well, you can see from the chart on the left-hand side that the outlook remains our expectation that we'll see a double dip in global manufacturing. And if you look in the right-hand chart, you can see that the weakness in the in the global manufacturing PMI new orders is also consistent with the trends that we've seen in real narrow money growth. Although we would expect that should start to bottom out later in possibly Q1 next year. So there's a lot been going on in China. It was a reversal of policy in China and an attempt to re-stimulate the market that caused that 35% rally in Chinese equities. And we have to ask ourselves, what do we think is going to result from this? So if you look at the chart on the left-hand side, and indeed on the right-hand side, the shaded areas show you periods of similar or slightly different stimulus episodes in the Chinese markets. And you can see that, we've got broad money supply showing up in this black line. And you can see that in the past, when we've seen significant stimulus, you've seen a sharp increase in the money supply, less so in the 2020 period. So we enter this period with very low real narrow money growth, and we would expect to see a response from that. If you look at the right-hand chart, you can see what happened in the past. So nominal GDP rebounded very strongly in 2008 and 9, and again in 2015 and 16 from those packages. However, the 2012 to 13 and the 2019-20 stimuluses failed to arrest a fall without giving a further significant boost. Again, comparisons that we can make about current expectations and policy that we've seen in the past. This is a picture of the yield curve in China showing 10-year yields minus 2 years, so the steepness of the yield curve. You can see that back in 2008 and again in 2016, 15, we had very high steep yield curves. However, in the current positioning, the yield curve is much less steep. So we think that the current policies will be enough to stabilize stocks given relative valuations, and that they will stabilize the economy. But we don't see a significant reflation at the moment. So we're getting constant updates to policy from China. But at the moment, we haven't seen anything that we would categorize as a bazooka. However, if you look at that chart on the right-hand side, you can see that even stabilization of the Chinese economy, and that's what we are expecting, that there is plenty of a valuation gap between MSCI China and the rest of emerging markets to allow further improvement in Chinese equity prices. So we're not as bearish as other people had been, but neither are we doing a 180 and becoming incredibly enthusiastic about the Chinese market. We think this is stabilization rather than reflation. Here we have the real money momentum for the E7. You can see that it had weakened in India, South Africa and Russia, suggesting less positive economic prospects in those. In addition to this, you can see that business optimism in India has cooled. So again, this is a reason why although we remain positive on India, that has come down slightly over the quarter. The rest of EM, you look at it, and monetary trends also suggest weakness in Korea, but they're holding up in Indonesia, Taiwan, and the Philippines. And we're more positive about the Southeast Asian markets of Philippines, Thailand, and Indonesia at present. If you look at currencies, we can see that there's been a big correction in Mexico and somewhat of a correction in Brazil. However, their currency remains relatively elevated and leaves those markets less than competitive in our view, while China at the bottom remains very competitive in terms of currency. So what a difference a month makes. And here you can see that 35% rally that I had spoken about, which at the end of the quarter resulted in a 24.5% increase in the Chinese markets. So you can see that it's gone and moved China into outperformance year to date versus the US and versus the rest of EM or the rest of developed markets when you exclude the US, which is interestingly a very similar chart in the left-hand chart for non-China and non-US EM and DM. So if we then look at the price indices over a longer period of time, so going back to 2020, you can see why we think this stabilization package could have further to run in terms of Chinese equities. So over that longer period, although they've outperformed year to date, they look as though they have significant catch-up possibility within them. So we will continue to tilt the portfolio in China towards more economically sensitive and the sort of high ROIC companies that we like, away from the defensive names that we had been favoring. So what are their outlook for the asset class? So, one of the key drivers in terms of our sentiment towards emerging markets in general is the US dollar. And we thought, and our chart on the left-hand side shows where we think that may have happened, we thought that we may have already seen a peak in the US dollar from October 22. Should that continue, then we would expect to see a significant rebound in the EM asset class relative to developed markets. So you can see in the right-hand chart just the degree of underperformance, which even though we think that we've started to see the reversal in the dollar, hasn't shown up in the relative performance of EM versus DM. And that was largely driven by Chinese underperformance. So to summarize all that in a portfolio summary of strategy, we expect global economic weakness to extend into 2025, at least till the end of Q1. Inflation globally is going to fall and is back on track. So we think that rate cuts will accelerate across numerous markets and economies. We think the Chinese stimulus package is credible. The size remains unclear and is likely to be made slowly more visible to markets. Now, we think that scenario is more associated with a stabilization of the economy and not a reflation of the economy. That, however, given the relative prices of Chinese equities, should be enough to allow some further performance from that market. The Indian economy is slowing, and the hitherto successful policy of anything but China for some markets, including India, is starting to lose its shine. So we think that the best standalone markets in terms of the beneficiaries of the rate cut environment that we anticipate globally are the ASEAN markets. So we are overweight Indonesia, Thailand, Philippines, Malaysia. we have a preference for those liquidity-sensitive markets versus cyclical markets, given that we don't think this Chinese policy is going to be reflationary, and we see a cyclical downturn in other global economies. We think that the currency overvaluation is still a concern for Latin American markets. And we think that the US dollar, although it's holding below its October peak, and it hasn't moved down sharply from there, we think that still supports a secular decline view, which would be very positive for the overall asset class. So that's my update. We've had a disappointing quarter in terms of relative performance, but we remain very optimistic for the asset class. We remain very optimistic for the ASEAN markets. We think that India and some of the tech markets take a pause, while China may have some further room to catch up. And we've positioned the portfolio accordingly. So with that, I'll say thank you and hand back to Anil.